What if the real risk in the gold and silver market is not price volatility, but the system behind the price? What if the biggest danger is not whether gold moves up or down tomorrow, but whether the structure of Western paper markets is slowly losing credibility? Welcome to Gold Silver Scope, where we break down gold and silver in simple, clear language so you can understand what is really happening behind the headlines. Today, we are looking at something very important: the difference between regulatory environments, paper trading, and real physical metal. Because the structure of a market determines whether you can trust the price you see on your screen. Let's start with regulation. In Western markets, especially in London and New York, the gold and silver markets are heavily influenced by large financial institutions. The London system operates largely on trust between major banks. The futures market in New York is dominated by big participants who trade enormous paper positions. On paper, these are regulated markets. In practice, many investors question how evenly those rules are applied. Large banks often operate with complex derivative structures. They can short in one market and hedge in another. On the surface, everything looks compliant. But when you look deeper, you often see paper contracts hedging other paper contracts. That is where risk begins to build. Because a hedge only truly reduces risk if there is real underlying value behind it. If you hedge a paper short position with another paper instrument, you are still inside the same paper system. If stress hits and everyone demands physical settlement at once, paper cannot create metal. Now compare this with what we are seeing in China. China has taken visible steps to tighten oversight in its commodity exchanges. Actions against spoofing and aggressive short selling have increased. Enforcement appears more direct and less tolerant of rule bending. Market participants there increasingly say that supply and demand determine pricing more directly, with less derivative distortion. Whether one prefers one system or another is not the point here. The point is trust. If institutional investors believe that a market offers a more transparent price based on real supply and demand, capital flows will gradually shift toward that system. And that is a serious long-term issue for Western exchanges. Because if confidence weakens in the pricing mechanism of London or New York, physical buyers may look elsewhere. Over time, pricing power can migrate. Now let's talk about something even more critical: the growing disconnect between paper and physical. Many banks still operate large paper short positions. These are often described as hedged. But if those hedges exist only within other derivative markets, the true physical backing may be limited. This works fine as long as few people demand physical metal. But the moment more participants start redeeming paper for physical, stress appears. This is what some analysts mean when they say the system looks fragile. At the same time, there is something interesting happening with gold forecasts. Many major financial institutions are now projecting much higher gold prices in the coming years, numbers that would have sounded extreme just a few years ago. That suggests something important. It suggests that large players may already be positioned for higher gold prices. Their paper books may be net long. In simple terms, they may benefit if gold rises. But here is the deeper point. Gold rising does not necessarily mean gold is becoming more valuable in real terms. It may mean the currency is losing value. And this is where most people misunderstand the gold market completely. Gold is not simply in a bull market. We may actually be in a long-term bear market in fiat currency. That is a very different idea. If currency purchasing power is falling year after year, then gold is not going up. Gold is simply reflecting the declining value of paper money. When you start thinking this way, your strategy changes. Instead of trying to trade gold volatility, you start thinking about wealth preservation. And this is the mindset shift that separates traders from long-term physical holders. The physical stackers, the people who consistently buy physical gold and silver over time without worrying about daily price swings, understand this principle. They are not trying to beat the market. They are trying to step outside of currency risk. And over long periods, that strategy has protected purchasing power remarkably well, because the real battle is not gold versus gold. It is gold versus currency. And that realization changes everything. Now let us go deeper into the most important idea in this entire discussion. It is not gold going up. It is currency going down. This sounds simple, but very few people truly understand what it means. When most people see gold rising from 1,500 to 2,000, then to 3,000, and maybe higher in the future, they think gold is getting stronger. They think gold is in a bull market. But think about your daily life. When you go to the supermarket, do prices ever go back to where they were 10 years ago? Does your rent fall back to old levels? Do energy bills return to previous lows? No. Almost everything gradually becomes more expensive. That is not because groceries suddenly became more valuable, it is because your currency buys less. Now apply that same logic to gold. Under a gold standard system, currencies were directly linked to gold. A banknote represented a fixed amount of gold. If you held a note, it was legally a claim on metal. Over time, that link was removed. Currencies became fiat, meaning they are backed by confidence and government policy, not physical metal. Since then, every major currency in the world has lost significant purchasing power. Take the US dollar as an example. Decades ago, gold was officially priced around $20 per ounce. Today, it trades in the thousands. Did gold magically become more powerful? Or did the dollar lose value over time? The same pattern exists in the British pound, the euro, the yen, all fiat currencies. So when analysts forecast gold at 6,000 or 7,000 in the future, they are not necessarily predicting a gold explosion. They may simply be anticipating continued currency debasement. And this is where the concept becomes critical. When people begin to understand that prices are not rising, but currencies are falling, behavior changes. There is a point in monetary history described by economists where the public finally loses confidence in currency stability. When that realization spreads widely, people try to exchange currency for tangible assets quickly. That is when monetary systems face extreme pressure. We are not saying that moment has fully arrived, but the awareness is growing. Inflation is no longer an academic topic. People feel it every day. Savings accounts earn less than inflation rates. Government debt levels continue to rise globally. Central banks expand balance sheets when crises appear. All of this slowly weakens confidence. Now connect this with the paper gold and silver system. If the public increasingly views gold and silver not as speculative investments, but as protection against currency risk, physical demand grows steadily. At first, institutions may ignore it. Then they may slowly adjust forecasts upward. Eventually, they may position themselves to benefit from it. But there is a difference between paper positioning and physical ownership. Paper exposure can be liquidated instantly. Physical metal requires real settlement. If more participants move from paper exposure to physical ownership, pressure builds inside the derivative system. That is why understanding the difference between speculation and wealth protection is so important. Buying gold to get rich is often a mistake. Buying gold to maintain purchasing power over decades is a different mindset. The same applies to silver, but silver has another layer. Silver is both monetary and industrial. It is used in solar panels, electronics, medical applications, and advanced technologies. That means its supply is influenced not only by investment demand, but also by industrial consumption. If currency confidence weakens while industrial demand remains strong, silver can become even tighter than gold. And when tight markets meet rising awareness, volatility increases. But remember this, volatility does not change the long-term purpose. If your goal is protection, short-term swings are less important. Many experienced observers have repeated one simple principle for years. Accumulate physical metal steadily. Ignore noise. Think long-term. Not because it makes you rich overnight, but because it removes part of your wealth from a system built entirely on expanding currency supply. And once you truly understand that it is currency losing value, not gold gaining value, your entire perspective shifts. You stop asking, will gold go up next week? And you start asking, how much of my savings is exposed to currency risk? That is the real question. Now let us bring everything together in a clear and practical way. We discussed regulation differences. We discussed paper hedging paper. We discussed the growing disconnect between derivative markets and physical metal. And most importantly, we discussed the core idea that gold is not really rising. Currencies are weakening. So what does this mean for you? First, it means you must understand what game you are playing. If you are trading futures contracts, ETFs, or other derivatives, you are inside the financial system. You are depending on counterparties. You are depending on clearing systems. You are depending on liquidity remaining strong. There is nothing wrong with that, as long as you understand the risk. But if your goal is long-term wealth protection, then physical ownership becomes a different category entirely. Physical gold and silver do not depend on a bank promise. They do not depend on a clearinghouse. They do not depend on someone else's liability. They simply exist as tangible assets. That is why, historically, during periods of monetary stress, people move toward physical assets. Now look at the bigger picture. Governments around the world continue to expand debt. Budget deficits grow year after year. Central banks intervene when markets weaken. Currency supply expands gradually over time. This does not usually cause collapse overnight. It causes slow erosion. And slow erosion is more dangerous because people adjust to it. They get used to prices rising. They get used to lower purchasing power. They get used to financial complexity. But eventually, more people begin to connect the dots. They begin to realize that holding large amounts of cash, long-term guarantees, loss of purchasing power. They begin to realize that savings accounts do not protect against inflation. They begin to realize that the system depends on constant expansion. That is when awareness spreads. And when awareness spreads, demand for tangible assets increases. Gold does not create wealth by itself. It preserves it. Silver does not magically multiply savings. It protects purchasing power over time. This is a very important mindset shift. If you buy gold hoping it doubles next year, you may be disappointed by volatility. But if you buy gold to remove part of your savings from currency risk, then short-term fluctuations matter less. The same applies to silver. At current levels, many analysts argue that silver remains undervalued relative to long-term monetary debasement. But again, the purpose is not speculation, it is protection. We are entering a period where financial systems are under structural pressure, not collapse tomorrow, but pressure building over years. And the earlier someone understands that the core issue is currency weakness, not gold strength, the more prepared they will be. That is why education matters. That is why understanding the system matters. And that is why we focus on structure here, not hype. If you want simple, honest breakdowns of what is happening in gold and silver, without noise, without exaggeration, make sure you stay connected with Gold Silver Scope. This channel is about clarity, long-term thinking, and understanding the real forces behind price movements. Protecting wealth is not about chasing trends. It is about understanding monetary reality.